LIBOR, the London Interbank Offered Rate, was the interest rate that set the price of roughly $350 trillion in financial contracts. It was embedded in mortgages, student loans, corporate debt, credit card rates, and derivatives held by every major institution on Earth. It was calculated daily based on submissions from a panel of major banks, describing what rate they could borrow at in the interbank market. What was not publicly known until 2012 is that for at least a decade, traders at those banks had been submitting false numbers, coordinating with each other to push the rate up or down depending on what made their trading books profitable that day.
LIBOR was not a real market rate, it was a survey. The British Bankers Association asked member banks each day to estimate their borrowing costs. No actual transactions were required, no verification was performed. The honor system governed the world's most important interest rate benchmark.
The manipulation had two forms. The first was trading-driven. Individual traders at banks would request specific LIBOR submissions from their own bank's rate submitters in order to benefit positions in their derivatives books. A trader with a large interest rate swap due to settle on a specific date would ask the submitter to push LIBOR up or down by a fraction to generate a profit. Internal emails recovered by investigators captured traders making these requests casually. One Barclays trader wrote to a submitter, "I'm begging you to set the rate at a specific level." The submitter replied, "Done." The trader responded, "You're a star."
The second form was reputational. During the 2008 financial crisis, banks submitted artificially low LIBOR numbers to conceal how much financial stress they were under. If a bank's submitted rate was significantly higher than its peers, the market would interpret it as a signal that the bank was struggling to borrow. Banks coordinated to keep their submissions low, which meant LIBOR was understated during the worst financial crisis in 80 years, masking the true cost of credit for instruments worth hundreds of trillions of dollars.
The investigation began in 2008 when a Wall Street Journal report raised questions about LIBOR's accuracy. Regulators in the US and UK launched parallel investigations. In June 2012, Barclays became the first bank to settle, paying $450 million in fines to US and UK regulators. The settlement documents included the internal emails. CEO Bob Diamond resigned. The investigation then expanded to 16 other major financial institutions, including Deutsche Bank, UBS, Citigroup, JP Morgan, and the Royal Bank of Scotland.
The total fines assessed across the participating banks exceeded $9 billion. Deutsche Bank paid $2.5 billion. The largest single bank penalty in the scandal, UBS paid $1.5 billion. Rabobank, a Dutch lender, paid $1 billion. Individual traders in the US, UK, and Europe were criminally charged. Tom Hayes, a former UBS and Citigroup trader, was convicted in the UK and sentenced to 14 years in prison, later reduced to 11. He was the first individual convicted in the LIBOR scandal. He maintained throughout his trial that his managers knew and approved.
The systemic question the scandal raised was about benchmark design. LIBOR was built on honor. There were no transactions to audit, no external verification, and no mechanism to detect manipulation short of reading the trader's emails. After the scandal, regulators in the UK and US worked to replace LIBOR with transaction-based benchmarks, rates derived from actual overnight borrowing in secured markets. The transition took years and was not fully completed until 2023. The replacement rate is called SOFR, the Secured Overnight Financing Rate.
What the LIBOR scandal demonstrated was not that individual traders were corrupt, though they were, but that a system built without any verification mechanism will be exploited if the financial incentive is large enough. The incentive was enormous. A 1/10 of a basis point move in LIBOR on a derivatives book worth tens of billions generates millions in profit per day. The traders knew, their managers knew, the banks knew, and the people whose mortgages and student loans were priced off this rate had no idea. Subscribe. Next video, the Federal Reserve operation that moved $29 trillion to the largest financial institutions in history.